All right, good afternoon, everybody. Mike Rains here from the Mike Rains Real Estate Channel, where we try to bring you some valuable information regarding the real estate information. And normally I bring you a lot of stuff from the real estate side of things, but today we're going to bring some information to you from the mortgage side of things. And today we have Mr. Jon Shrum with us. He's president of the KMC Group over at Arbor Financial here in the Orange County area. He's been in the industry for 22 years. And he's had the 5-star mortgage originator award since 2010. So every year since 2010. And he's helped over 4,800 families be able to realize the dream of home ownership. And he specializes in the primary residential market, second homes, investment properties, and up until recently, probably refinance market was a big part of your portfolio that you did. Welcome to the channel, Jon. How are you?
I'm doing good, Mike. How are you doing?
I'm doing fantastic. Well, good. I'm looking forward to kind of hearing from your perspective today, what's going on the mortgage side of things and really kind of how it relates to the average person that's seeking to buy a home, and maybe even touch on stuff that affects a home owner as they're thinking about either selling and moving out of state or downsizing, upsizing, that kind of stuff. But our featured product that we're going to talk about today was something that you had mentioned the other day that I found really fascinating, and we're going to get to that. But it's a new product that I've not heard of tons before, but where the product it qualifies itself. So we'll definitely touch on that. But I want to bring to the listeners kind of from your perspective what's going on. So what are some of the changes that you've seen lately in the real estate market, maybe since the beginning of the year to now? What do you see happening out there, and how is that affecting your business from the loan application side?
Yeah, absolutely. So I think one of the challenges or the changes that we saw from the beginning of the year to where we are now, obviously interest rates have changed. And if you have someone that was qualifying at 500,000 and now they're a point higher in interest rate, well, that's going to affect them, right? So we've seen that. And obviously I think we've all seen a little bit of a slowdown. I'm a little slower than I would like to be, but still blessed to be busy. But it's finding new ways to and creatively get someone still into a home with those higher ratios right now because of higher interest rates. Okay. So what can we do to alleviate that? How can we keep people in a payment that they're comfortable with? There's a lot of fear factors right now, right? There's a lot of shock factors. Okay. That rate go up almost a point or over. Now,
are you seeing like changes to programs to enable that, or are the underwriters expanding those back-end ratio guidelines? What's happening on the loan side there that helps out the borrower?
We're seeing a lot more of the FHA side. Okay. Right? I know that's become more popular than we've seen in the past because FHA, being that it's a government pool of money, typically carries a lower interest rate because they have that mortgage insurance pool. We're seeing Fannie Mae and Freddie Mac raise debt to income ratios. Absolutely. They've gone up to as high as 55% on the back end ratio. I always tell customers, people are not numbers, but a loan is, right? Yeah. And a lot to the consumer, they're like, well, Jon, what's a ratio? Well, it depends whether or not we go above a margin here, whether you can qualify or not, right?
Right.
It's just on paper. It's a computer telling us this, but yeah. And also we have seen a lot of new products come out that are, if you want to call them somewhat creative, where they're still fixed and there's still security for these folks, but maybe we're doing a shorter term. Okay. Or maybe we're doing an ARM product, which can still reduce that interest rate and keep them within their comfort level. Okay. So they still buy that home.
So can you give an example of that kind of loan program?
Absolutely. So, the LIBOR ARM was around for quite a while. And when we talk about ARMs, we're not talking about pay option ARMs back in 07 and 08. Right? Okay. So the pay option ARM days are gone. Still know some people that are out there on those loans, but the SOFR has taken over what the LIBOR used to be. And now when you look at a 5 or 7 or a 10-year, well, they're fixed for those terms. And a lot of folks don't understand that. They hear the ARM, they go, oh, no, I don't want an adjustable mortgage. Well, if we're looking at a 7 and 10-year loan, there's a lot that can happen in 7 or 10 years.
Yeah, and we've seen, especially since the pandemic changed the numbers a little bit, but previous to the pandemic, I think the average either time that they were in the home or that they were actually in that loan was around 7 years. But I think that's kind of risen a little bit up to about 9 years. Is that about what you're seeing on the?
Yeah, I think that's a good average. Yeah,
Okay.
absolutely.
So people,
yeah.
so what I'm saying is that people either, have sold the home to move on to either a bigger home or out of state from a job change, or for whatever reason, they've needed some capital. And so they've refinanced that loan to pull that capital out or consolidate some loans. So what you're saying is that, people are kind of not brainwashed, because I think a 30-year fixed rate is a good thing. It brings a lot of comfort, but it may not be necessary. And so with the tick up in the interest rates, those are some programs that I've heard, and now you're bringing up again, where somebody can be able to take advantage of a slightly lower rate than what. So can you give us an example of kind of what a 5, 7, or 10-year might look like in comparison to a 30-year?
Well, today,
well,
so typically you're looking at about 0.25% to 0.5% less. And in
okay,
some cases more than that, right?
okay,
And being that I'm in the broker world and correspondent, I have multiple investors. I think that's important for folks to understand. A lot of people are shy of brokers. For me, it's where I can get the best possible deal for that customer. At the end of the day, it's you're just making a payment to this company,
right.
but we need to be able to shop and see what we can do and what's the lowest rate that we can get for someone. So
yeah, and that might translate, that 1/4 point to a 1/2 point might translate the difference between someone being able to get into a house or
absolutely.
a condo if they're on the edge there, or even being in the market altogether. Is that right?
Absolutely. Yeah.
Okay.
Absolutely.
I remember when I first bought my very first place, it was a condo. I did the 5/1 ARM and it got me in. I think I even did the interest only option in the beginning. And that really kind of helped me. I was a first time buyer, so I needed to be able to handle that payment. Well, as I grew in my career, so did my income. So I redid that loan before the end of that maturity. So I was able to step into a 30-year and really make the difference. And the rates were dropping, so that helped too.
Yeah, I remember my first home was with Countrywide. That's where my loan was, and it was 100% financing, fast and easy.
Wow.
720 FICO score and above, right?
Okay. All right.
But
fantastic.
hey, it was there. Yeah, and that's how I got into the market.
Well, and so many
years
people.
old.
Yeah, sorry about that. So many people, they hear the word ARM and they think, oh, even if you went from a fixed rate into that variable portion of the loan, that they thought, oh, your loan's going to skyrocket in payments. And that's not what we saw, because the interest rates were dropping and we saw people's payments actually go down with those, not up. Now we're in a different environment, and that kind of brings me to our next little segment here. The Fed's going to meet next week. They're going to be announcing what they're going to be doing. We get the inflation numbers that print on the 13th, and then a couple of days of the meetings, and then they do it. What are you guys anticipating that's going to come out of that meeting? Are they going to raise? Are they going to hold? How much? What are you guys actually anticipating? And really, how's that going to affect the mortgage rate? And explain the difference between what the Fed's doing and how that translates into the bond market and the mortgage rates.
Absolutely. So I think we're all hearing right now that they're more than likely going to raise again, right?
Okay.
And anytime they make a raise, I am on the phone because it gets very quiet and people get very scared. But I think what folks don't understand is when the Feds come out and say they're raising a rate, that doesn't necessarily affect mortgage rates in a negative. If they're sticking to their guns and they're raising the Fed rate, that will affect prime. It absolutely affects an equity line right off the bat. Okay. So if we come up another 0.75 or 0.5%, know that your equity line is going to increase, right? Okay. If you're on an adjustable. But if they stick to their guns, typically that means there's security going back into the bond market. And the bond market is what drives mortgage rates. Okay. So we watch the 30-year and we watch the 10-year very closely. The 30-year is what we're really putting our money on right now in the mortgage industry. Okay. And if that adjusts, again, if they do that increase, it's actually securitizing more money into the bond market. And it's actually a good thing for us. Okay. So you're anticipating that rates are going to kind of level off a little bit here if they do that, or what do you think by the end of the year? Let's say what an average buyer can expect. Are we going up in rates into the end of the year? Have we seen kind of a short-term top in the interest rates for mortgages? What are you guys anticipating there? Well, I think yesterday was a big day in the market, right? We saw a major hit to interest rates, and now it's started to plateau out a little bit again. It's not just the Fed's meeting. we had the ADP report coming out on the job claims, right? They're actually holding that until the end of August, which is unusual.
That is
Typically,
unusual.
it is very unusual. And they say it's because they have a new algorithm system or something going on. But for them to do that, you got to kind of question, okay, what's happening, right?
That means it was a really rotten number and they don't want to blow it up.
Yeah. And the challenge is, I watch the market at, I get an update at 6 o'clock in the morning and then 2 o'clock in the afternoon every day just to see what's happening. Because this is a global economy now. It's not just us.
Yeah.
So it's difficult to say what's going to happen.
Okay.
I hate to say the word recession, but for me, recession is great.
Yeah.
And it's good for the mortgage industry. And I think if that button gets pushed, we may see things change dramatically.
Yeah.
I'd say for right now, we're kind of plateauing.
Okay.
Right.
Yeah. And I think you're right about, like, recession sounds like a nasty word, doesn't it?
It does.
People hear that and they think, oh, the sky's falling. Now that's a depression. Recession is just, and I've been telling people on this channel and other places that it's like that pressure cooker, and the recession just kind of lets a little steam out of the market, kind of cools things off a little bit, because it was pretty red hot. I think you probably did a lot of mortgage applications. We were selling a lot of homes, and homes were just going out of control in the pricing because there wasn't enough inventory and you had low rates. And so people were going after them with reckless abandon, really, and they were driving the prices up. And now we're seeing that kind of tamping down on that demand, and because of those higher interest rates. So as we go into that, we're going to see just a normal kind of softening in that. And if we don't have that, that's when things get a little unhealthy. Would you agree with that?
Yeah, I absolutely agree with it. I think recession is a necessity.
Okay.
So,
yeah, I think we saw what happened in 2008 when they didn't have the recession in 2003 and 4, that it kind of built up that excess pressure and it cracked and then it really came crashing down. For those that track my channel and seen some of my recent updates, you know that the market isn't going to plunge. The fundamentals are so different between what was back in 2008 and what's available in the fundamentals today, not only in home ownership, but also in the amount of people that don't even have a mortgage. It's so much higher today than it was back then. And we'll also see this tappable equity, where it's like $11 trillion of tappable equity. And so a lot of people's position in their homes are so much stronger. And I think you would agree that also the borrower has a lot more things that they have to qualify for. You actually have to qualify for a mortgage. Whereas back then, you really didn't have to do that.
If you could, fog up the mirror, you're going to qualify for a mortgage, right? So,
all right. So we kind of covered one of the questions that we were going to go over, which was like the different programs. So what I want to do now, so we've had these different programs come out, and you can touch on the VA and the FHA as one of the programs, but there's a special program that I want you to get to.
Sure.
And in regards to investment property, and that's what today's video is all about, is being able to talk about that. But if you want to touch on, VA and FHA as one of those alternatives and why that's actually not in vogue again, but because people they went for the regular stuff because you didn't have to go FHA. And now things are changing a little bit. Maybe you can touch on that, and then we'll dive into our featured program.
Yeah, absolutely. I think FHA has always been there, right? And I think it's a good way for a first-time home buyer with maybe a couple of challenges on credit, or maybe we got a little bit less money. We're just starting out in the world and we're trying to purchase a home. It's always been a very good way to get into a property. Right now, because of what's happening with interest rates and because it's a federal pool of money, you're always going to have a slightly lower interest rate than you would on a 30-year fixed, right? And if folks are trying to come in with 3 or 5% down, the mortgage insurance is typically a lot less than what you would have on a conventional. What's really important to know, though, is that you have to refinance yourself out of an FHA loan. That mortgage, I don't care who tells you anything differently. The mortgage insurance does not come off. Doesn't matter if you put 20, 30, 40% down, it does not matter. You have to refinance or sell that property.
Okay, so if you get an FHA loan, that comes with it.
Absolutely.
No matter what.
Whoever your mortgage consultant is, they should be contacting you on 6-month, 12-month, 2-year plans. I do that for all of our customers, and we go back and we take a look at their loan program, see if there's a benefit for them to refinance. It all depends on what the market's doing. VA is near and dear to my heart. I have a lot of veterans in my family, including myself, but For us, the VA loan is a great way for a veteran to get into a home. It's 100% financing. There is no mortgage insurance. It's always going to carry a lower interest rate than the 30-year fixed loan. And there is no limit to a VA loan anymore. There are no county limits. They don't exist anymore.
That's
It's amazing. It's amazing. So for any veteran out there, great way to get into your first home or your second, third, whatever it may be. Always look at the VA benefits.
Okay, cool. All right. Well, I'm excited because this segment right here, we're getting into what I think is a really unique and exciting program for those that want to build wealth, for those that want to use real estate as a tool to increase your lifestyle and your ability to be able to have the good life. This program really spoke to me when I heard you present it. And so I was really excited to be able to bring this at. What's the name of this program? What is it all about? And why should someone take a serious look? If you're an investor, why should they care about this particular program?
Oh, there's so many different names for it, right? But it's a DSCR loan, which stands for debt service coverage ratio.
Okay.
Exciting stuff. But what this means is that for the investor who's trying to qualify to purchase that next investment property and has multiple corporations, or maybe they have one corporation and they can write off what they need to write off because we have the right to do so. It gets more and more difficult for an investor to qualify when you're looking at a full documentation loan. What a debt servicing loan allows for, it is a no income, no ratio loan. It's basically the property qualifies for itself. And it's based on the rents that they can get for that property. So we've always been able to add rents in the past, and we use 75% of that occupancy on that new property to give those folks new income. But the challenge was that you still had to qualify based on a tax return, or you're doing private money, or you're doing a bank statement product that might carry a much higher interest rate.
Okay.
Rates are very affordable on these type of programs, and they are built for that investor who is looking at building their portfolio to build wealth.
So is this a program that every investor should look at, or is there some things that they need to be careful with on this type of loan? Is there any reason why someone would not want to do this loan?
I think the only reason you wouldn't want to do this loan is if you qualify full documentation, right? This is still it's an absolute non-qualifying mortgage. It's a non-QM product because literally we're putting zero income on the application for these investors.
Okay.
For this person who's buying another investment property.
Okay.
There's no income that goes on the application. It's based on how much rents we can show, anywhere from 1% and up on that new property. And when we mean 1%, it's a ratio of what the rent roll looks like, plus what the expenses are on that property. So we do a full breakdown at the beginning, get a full list of, most of these properties, we can get a breakdown of the property profile. We can see what the taxes, insurance, everything that's going to be on that property, and see if it's going to debt service itself. From there, we can start building the loan proposal and showing them numbers. So obviously, hey, if you can qualify full documentation and you want to come up with those tax returns and the 1120s and the K1s and all the schedules, and we can qualify you that way, I'm always going to recommend that you do that because it's always going to carry a lower interest rate than if you do a non-QM loan. But the majority of my customers look at these debt servicing loans. They look at their positive cash flow to see where they're going to be on that property. It makes sense. It makes sense. Okay. And it's a very popular product. In fact, you Google it, you're going to see it all over the place now. So it's been around. Now it's becoming part of the mainstream.
Okay. Well, and isn't there in regular full documentation, Fannie Mae, Freddie Mac type loans, aren't there limitations to how many investment properties they can have?
Absolutely.
And if that's the case, is that also transfer over to this? Or is this one of the solutions to someone that's building a portfolio of properties? That's
a great question. So there are some investors that will limit on DSCR. I have multiple investors that do not. And that's really important for investors to know, because it's a very good question. It comes up quite a bit. John, I've got 10 properties already. I want to add another 5. I'm being told by my bank I'm limited to 10. This eliminates that issue.
Yeah, well, as a realtor, I'm like, well, let's sell your 10 and we'll parlay that into a multi-family unit building.
Yeah. As a lender, I'm going, let's equity out on these properties so you can buy the next 5, right?
Okay.
Or whatever it may be.
Well, I've been talking to people about taking some of their awesome equity that California has brought and taking it out of state. These are available in all of the states in the United States?
They are.
Okay.
So in fact, a DSCR loan for the brokers out there, if there's any other mortgage brokers on there, if you're not licensed in that particular state, because it's a DSCR loan, it does
Okay.
not follow what we call Reg Z.
Okay.
So you do not have to be licensed in that state to be able to do that loan.
Okay.
So there, I just added more business to all the mortgage brokers.
There you go. Look at that. You're so nice.
Trying to help out my community.
I'm sure that there's a loan limit on that. Could you share about what if any loan limits are?
So the highest that we have right now is 5.5 million.
Okay.
And that's
Right.
pretty high up there, right?
That's pretty good. And is that for single families, or is that up to 40 units?
So that's up to 4 units, multiple units on the conventional, or excuse me, on the residential side. You
Okay.
can also do a DSCR type of product on commercial. And I do not have a limit to the units.
Okay. Yeah. I think we always understood that they kind of qualify themselves in a commercial world, right?
Correct.
That was already kind of how they structure it, but they only do it for like a 7 or 10 year deal anyway, and then you got to redo that.
Correct. Yeah.
Right.
Well, now
Okay.
they have 30-year fixed on the commercial end.
Okay.
Also. But yes, this is kind of, and that's perfect. This is adopting what we've had for years on that commercial product, now allowing us to do it on the residential side up to 4 units.
Okay. All right. And, investors that I work with, you're a real estate investor yourself. It's all about cash flow, right?
Yeah.
So is there an interest only option to be able to help those that are really conscientious about having cash flow?
Absolutely. So DSCR has interest only options on it. There are products that have interest only. The ARM products that we kind of talked on a little bit about, the SOFR, a very, very secure index now on it as compared to the LIBOR. That's kind of why they did away with the LIBOR.
Okay.
And the 7-year and 10-year, they can qualify on an interest only payment. It does not have to be fully indexed. So we're talking, let's say 4.5% or 4%, whatever that rate may be.
Okay.
We're qualifying based on that interest only. We're not taking it, the index plus the margin and qualifying on the fully indexed rate.
Okay.
So, yeah.
And that's typically a little bit more savvy of an investor that kind of understands that, if they're doing the interest only, they're not picking up equity on that side of things and so forth. Now, in our area, we hear a lot about VRBO. We hear Airbnb and stuff. People buying investment properties for that. Is this type of loan program, is it suited for that?
So for Airbnb, so the DSCR, if we're looking at a DSCR, that's for a future purchase, right? We can actually do DSCRs on refinances as well. So they can do a refinance, cash out to purchase that other property.
Okay.
So Airbnbs are being accepted now. The only challenge with Airbnb is that we have to see a Schedule E. Yeah. Right. Yeah. So, but the Schedule E is only a small portion of the tax return. Right. So, and a lot of my investors go, oh no, John, I don't want to show the returns. Here we go. I go, no, let's just look at the Schedule E. And as long as we can qualify and show that there is rents coming out within 6 to 12 months, then yes, we can use that income. Okay. And you think it's like a 1 year's worth on a Schedule E, or do you have to go multiple years? I've been able to get exceptions as little as 6 months. Oh, wow. Okay. All right, perfect. Well, that's kind of an exciting program. So, I mean, for those that want the option and availability to be able to expand their portfolio, you've got enough down, but you're not looking good on your own personal tax returns, or you just don't want to do that. This sounds like a really excellent opportunity for someone to be able to pick that up. So I always end the interviews with kind of an off the cuff type question. And hopefully this doesn't hit you like, you're like, oh my gosh, like, how am I supposed to think of this? But what's the funniest thing that's happened to you over the last, maybe a year or two that you might be willing to share? Just something personal, something that maybe has happened to you. What's the funniest thing that's happened to you? So I'm going to put my wife on the hot seat. So I pay a lot to get my hair cut, which I don't have a whole lot left anymore. And my wife decided that she cuts my daughter's hair when they were little, and she does a good. Timmery, you do a good job. So she decided she wanted to cut my hair, and I just do the buzz. So I had, I think, a 4 or 6 on the clippers, and she came out and said, "Hey, I'm going to clean up the back of your neck." I said, "Okay, babe, that's fine." And she's standing behind me and she's cleaning up the back of my neck. Well, she didn't have a 4, she just had the razor on there. And no! I've got a nice little spot now, which I'm not growing any back, it seems, at this point, but I've got a nice little spot back here now that she added. That's funny. That is funny, so actually. It's one that sticks with me for sure. So
That's
And I
awesome.
love you if you're listening, babe.
That's well, hopefully she'll see this. Well, hey, listen, it's been great. Thank you so much for taking the time out to be able to help our viewers this channel be able to understand a little bit more about what some investment property opportunities look like and just the general, real estate market. We luckily in our area in Orange County, we're seeing an uptick in inventory, but that's been the one thing that has really kind of saved us from any kind of a large softening in our stuff. We just don't have enough inventory. But I think that a product like this would help somebody have the opportunity to be able to get some investment properties while the pricing has come down a little bit. We're only anticipating single digit type of softening, which is normal. So this might be a good opportunity for someone to do that. So recommend that you reach out. I'll put Jon's information in the description. Make sure you do subscribe to this channel if you like this kind of content, and make sure you make a comment and a like it. And that way we can bring you some more content like this in the future. So thank you so much for joining us. I'm Mike Ranger, host, and thank you for joining us.